pricing a bond. Okay, so we talked about bonds. Let's talk about bond pricing. So as I mentioned in the previous video, the cash flows are the patterns that we already know. We have an annuity component, the coupon payments, and the lump sum component, the par value that investors get when the bond matures. Okay, so basically we're going to combine the PVA formula that we learned in topic 3 and the PV formula that we learned in topic 2. Okay? Basically we're treating this as a combination problem on a regular annuity and a lump sum cash flow example. Okay? So price of a bond equals present value of the coupons. So this part is just your PVA formula. And this is the PV formula, right? They're identical. Okay, we're just calling the future value, par value, and so on. Okay? So that's the formula, but you have to adjust the components slightly. Okay? Here, the R that you're going to use in the calculations is actually YTM over M. Okay? The yield to maturity will usually be given to you. And M, as we talked about, is the frequency of compounding per year. And it's either 1 or 2, depending on whether it's an annual coupon bond. For annual, you'll use 1. And for semi-annual coupon bond, you'll use M of 2. Okay? So you gotta adjust the R and you gotta adjust the N too. Okay? So if it's just an annual bond, you'll see in the examples later, N is just a number of years. If it's a 10-year bond, then you use N of 10. Okay? But if it's a semi-annual coupon bond, basically the units on the timeline become 6-month periods. Okay? Meaning, if it's a 10-year bond, you're going to do 2 times 10, and the final N here will be 20. So the timeline consists of 20 6-month periods. Okay, you'll see an example in the other videos. Okay, and the coupon payment is just a par value, $1,000, times the coupon rate, which will be given in the problem usually, divided by M. Okay, so you gotta pay attention to the M's. You gotta use the right inputs to get the right answer, right? So make sure you pay attention to these details. Okay. So do examples 1, 2, and 3, and then we'll continue here. So bond price sensitivity. So we have the bond pricing formula, and we just want to talk about how the bond price is related to the yield to maturity, keeping the other components equal. Okay? It just means we're going to keep the coupon rate the same, or coupon payment. We can put in numbers here. Let's say the coupon payment is $100. The N is 10. Okay? The par value is $1,000, and N is still 10 here. Okay? So it's asking if the yield to maturity goes up, YTM goes up, what should happen to the bond price? Should it go up or down? Okay? So if you look at the math, it's easy to see that all the R's are in the denominator, right? So if the R's go up, the value of the fractions all come down. So mathematically, it's easy to see that if the YTM goes up, then the price of the bond should go up. Should come down, sorry. Just mathematically, right? but we also want to think about this conceptually. Okay. Yeah. So if you recall, in topic 1, there was a slide called the determinants of stock price, where we first talked about the this formula. Where's that? This PV formula, and I first introduced the 3 components in securities pricing: the future value, the risk, and the timing of the cash flows. That was how it was worded in that slide. Okay, so we're gonna use that setting to illustrate how the bond price is related to the YTM. Okay, so in that slide, in the determinants of stock price slide, I mentioned U.S. versus Iran. Okay, let's say they're both promising these cash flows. In 1 year, they're both promising a payment of $100. I forget the exact numbers, but this is what we did. Okay, so if they're both making the same promise, so we're intentionally keeping the future value, the N, the same, we're varying risk to see how the price should react. Okay, so here, since financially, U.S. is more stable, maybe the price of the U.S. bond will be $98. That'll be the market price. Price of an Iranian bond right now, things are not looking good. So maybe investors will apply a huge discount and making this cheaper, right? So basically, what I was illustrating is that the risk of the U.S. is a lot smaller compared to the risk of Iran, okay, from investors' perspective. Okay, so the R captures risk, okay, but it also captures the rate of return. It's a little bit tricky here, but R is capturing risk and the rate of return at the same time. That is, now let's say we have this deal, U.S. government bond deal and Iranian deal. Okay, so another way to interpret this is if you put $98 into a U.S. bond, you get $100 in the future. Okay, that's like I don't know the exact number, probably a little more than 2% return. Okay, 2.1%. However, if you put in $35 in an Iranian bond, then you'll get $100 in 1 year. Okay, that I don't know, but that's probably like approximately 300% return in 1 year. Okay, so this illustrates the point. Risk is basically correlated to return. Okay, and this again goes back to the fundamental assumption in finance, which I talked about in the first lecture, that investors are risk averse. Right? So investors are basically saying, if you're gonna expose us to more risk, if you want me to go from here to here, if you're gonna expose me to more risk, you better promise a greater return. Otherwise, I'll just pick the safer option if the returns are similar. Okay? So unless the Iranian government provides a greater rate of return, their product basically cannot exist in the market, because all investors, they're risk averse and they'll just go to the US market if the returns are identical. Okay? Yeah. Okay? So yeah, that was maybe a little complicated, but same thing applies in the bond setting. Okay? Clear this. So basically, we had U.S. versus Iran, but let's say we'll use the same example. U.S. They have longer term bonds with coupons. I know U.S. does, but so let's say U.S. their deal is now this $100 every year, and at the end you'll get your par value and another $100. Iran, same thing. They're making the same promise. 10 years, 1,100. Same thing, right? The cash flows are now a little bit more complicated because we're dealing with a more complicated deal, but the price of this thing might be $980. I'm making it up. But Iran, even though they're making the same promise, because they're more risky, I bet the market price of this thing will be a lot lower. I'll just do like 550. Okay. Yeah. So again, this means the R for the US bond is smaller. Okay. I'm just making the numbers up. Maybe it's like, I don't know, 40%. Okay. So R is basically the yield to maturity, as we talked about. So if the yield to maturity goes up from here to here, keeping all the other components the same, the cash flows, the timing, everything else remains the same, but the R goes up, the price should come down. Okay. Yeah. Just conceptual. Okay. Yeah. So how is the bond price related to the coupon rates? Mathematically, it's easy to see that if you keep all these things the same, all the components the same, and if the coupon rate goes up, then the bond price should go up mathematically, right? And thinking about it conceptually, it also makes sense. Let's say the risk remains the same and the number of years remain the same, but greater coupon payment means you're just going to get more cash flow every single time. Let's say the risk is the same and everything's the same, but suddenly you're being promised a greater cash flow every single year. Okay? Then, obviously, this is a better deal, right? Conceptually, better. Everyone likes it better. So, in asset pricing, anything that's better will be priced higher because it's more valuable, right? So a greater coupon rate, all else equal, means a better deal, so the price will be higher. Okay, conceptually. And mathematically, again, it makes sense. Okay? Yeah. Yeah, so another conceptual slide. Yeah, as you saw in exam 1, there will be problems on conceptual stuff as well. Okay, so this table you want to have in your little formula sheet, or well, it's open notes in the summer. So yeah, you want to pay attention to the slide. Okay, so bonds can be classified by comparing the bond's market price to its face value or the par value. Okay, that's so based on this relationship, bonds are classified into these different types. Okay, so whenever the price of the bond is equal to the par value, we say it's a par bond, or the bond is trading at par. Or when the bond is first issued, we can say bond is issued at par. It just means the price of the bond when it was issued is $1,000. Okay, so for par bonds, just mathematically, the coupon rate is equal to the yield to maturity. If you do the calculations, you'll see. Okay, so if I gave you a problem where the coupon rate is 4% and the yield to maturity is also 4%, when you apply the bond pricing formula, you'll see that the price of the bond will come out to be $1,000. Okay, just how it works. And when the price of the bond, the market price, is greater than the par value, we say it's a premium bond. Okay, and for premium bonds, the coupon rate is greater than the yield to maturity. When the market price is less than the par value, then it's a discount bond, and for discount bonds, the coupon rate is smaller than the yield to maturity. Okay. Okay. Let's talk about the various rates in bonds. We already talked about the coupon rate and the yield to maturity, but we'll review it again. But the current yield is new. Okay, so let me show you. First, not this. Another Apple bond. Okay, this is the example that we saw last time, right? It was the 30-year Apple bond. So what I'm trying to show you is that the coupon rate of a bond never changes. Okay, so remember the bond certificate, so that's just the deal. Okay, so it's used to calculate the coupon payment, and the deal never changes throughout the life of the bond. Okay, so the corporations will pay the investors the promised coupon rate because they can't just change the deal. Okay, however, I'll show you soon that the yield to maturity changes just like the stock price. Okay, the definition of yield to maturity, you saw earlier that it's the expected annual return if the bond is held until maturity. So if whatever the market price is, let's say this is the bond, and the current market price is $9.95 or something. Okay, so if an investor pays this amount and collects these payments in these years, and if you calculate the R, the annual rate of return, that is the YTM. Okay, so it's the expected annual return if the bond is held until maturity, and this yield to maturity changes all the time. Okay, let me show you here. So again, this was the Apple bond, where I think it was this exact example. The annual coupon rate was 4.45%. That's the deal, so that never changes. Okay, but as you see here, let's look at the yield. This tab is the yield. Okay, since inception, the yield to maturity, first it was near the coupon rate, right? 4.5 was the coupon. 4.45 was the coupon rate, was it? Yeah, 4.45 was the coupon rate, and the yield to maturity at its inception was 4.48. So the bond was trading or issued near par, right? But the yield to maturity fluctuated throughout the life of the bond, as you can see. So the yield to maturity actually fluctuates quite a bit, and this depends on the risk-free rate in the market. So we'll talk about that soon. Okay, so this depends on the risk-free rate in the market, but it fluctuates based on market conditions. That's the key point here. Okay, and if you recall, I don't know if I can write on this page. Wish I could. Let's go back here. So this is the deal, right? Oh, okay. So let's say this is the deal. This was Apple bond. Let's say 30. I don't know. So this is the deal. Oops. Something like that. That's the deal, right? So as you can see here, the yield used to be 4.48, but at one point it was like 2.2. So if the yield, we'll just call it R here. used to be like 4.5, but later on it becomes like 2.5%. You'll see that based on this R, the price of the bond will also fluctuate, right? We just learned about bond pricing, so keeping all these components the same, if you use a different R, obviously PB will also change, right? And we just mentioned that, did we? Yeah. Bond price is inversely related to yield to maturity, okay? As R goes up, price comes down, right? Inversely related. So let's look and see if that's what actually happened. So let's do just 6 month maybe, 1 month. Actually, yeah, let's look at 1 month. Okay, so here in the past month, we'll look at it from here to here. Okay, you can see that the yield to maturity increased until like June 8th, right? Yield to maturity increased, so the price should have come down. Yeah, until June 8th, the price came down. Okay, it's just math, right? If the R goes up, price comes down because the promised cash flows remain the same and the deal remained the same. The only thing that changed was the what changed? Yeah, the R changed. Okay. Yeah. Okay. So yeah, saying a lot of things, but the coupon rate doesn't change. Okay. Yield to maturity changes based on, actually, to be precise, it's based on market conditions. Specifically, the risk-free rate. And then the price changes subsequently. Okay. And the current yield. Okay, current yield is new. Okay. So current yield is similar to the yield to maturity. Notice that both terms have the word yield, right? So it's some kind of rate of return, but the yield to maturity, YTM, is the rate of return if the bond is held until maturity, but the current yield is the rate of return if you hold a bond for a short period. Okay, so we'll just say approximately like 1 year. It could be 2 to 3 years maybe, but we'll just keep it simple and say short period is 1 year. Okay, and the formula for current yield is this: annual coupon divided by price. And the current yield changes based on the current price. Yeah, because as we just saw, the price of the bond changes all the time. Okay, let's explain current yield real quick. Let me just use my other thing here. Okay. Current yield. So let's consider this bond. So looks like this: 10 years, 100, 100, 100, 100, and 1,000. Okay, and let's say I'll give you the price. The price right now is $9.50. Actually, I'll make it an easier number. Let's say it's trading at par, $1,000. Okay, so yeah, if we treat this as an annual bond, you'll see that the coupon rate is probably 10%, right? Since the par value is $1,000 and you're only getting $100 every year, what was it? The coupon payment formula was par times coupon rate over M, which is 1 here, right? So the coupon payment of $100 equals 1,000 times 0.1, 10%. That's why it's 10%. But anyway, it's 10%. And so the point here is, sorry, I'm getting lost here, but coupon rate, since it's a par bond, we know that the YTM is also 10%. Just trying to link the concepts that we talked about, okay? From that little table, right? Coupon rate is equal to the YTM, then the price of the bond is $1,000, okay? But anyway, what I'm trying to show you here is the YTM is for long-term investors. If you hold a bond until maturity, then they care about this because they plan to hold a bond until maturity, okay? But let's say you're a short-term investor, okay? Short-term investor don't care about the YTM. Don't care about the YTM because their plan is this. They're gonna focus on, actually, let me just clean this up a little bit. They're gonna focus on this part right here. As a short-term investor, that's your plan, okay? That is, let me make that, let me sort of zoom in here. Doesn't have to be this big, but and then the timeline continues, but they don't care. Their plan is they're first gonna purchase the bond at $1,000, and then they're gonna collect the $100 coupon payment, okay? And then they'll sell the bond at whatever the bond price is in time 1, okay? Whatever this is, okay? So let's try to come up with their return, okay? I'm gonna try to come up with an expression for the return for this short-term bondholder, okay? Focusing on this part right here, okay? So a return is usually decomposed into two parts. There's a capital gains component plus the interest component, okay? So here, the plan of a short-term investor is they're gonna sell the bond. I'll just say expected price in time 1 minus whatever they paid in time 0 over P0, okay? They're gonna sell the bond in time 1 and they paid $1,000 here, and this is how you calculate the return, right? If if the bond price happens to be $1,200 in 1 year, you paid $1,000, then the return is 20%, right? That's what I'm showing you here using an expression, okay? And the interest component is the $100. They get $100 by paying the $1,000, okay? Actually, let me just put in numbers here so it's less confusing. $1,000 they put in, $1,000 they put in, okay? And here's the tricky part. We're not gonna go into much detail, but the key thing here is the expected price of this bond in time 1 using all available information at time 0 is still $1,000, okay? So we're not going to go into much detail, but this deals with market efficiency. Basically, it's saying based on current information, we're looking at the world from time 0, you cannot accurately predict the price in the future. If one could, they would be extremely rich, right? But the markets are pretty efficient that the current price reflects all available information. So the price will change according to future information, but right now the best guess is that the price in time 1 will still be $1,000. So the plan for a short-term bondholder is the capital gains component will be 0. It's the expected capital gains, but the interest component is pretty certain, right? It's a 10% return, right? Because the coupon payment, the bondholder knows what they're gonna get, and they already know how much they're paying for the bond, okay? So the expected return for a short-term bondholder, if we focused on this time frame, is just 10%. So the annual coupon over the price of the bond. Okay. So this part's a little confusing, but I'm just trying to show you where the current yield formula came from. Okay. So if you understood this, you'll see that that's exactly the formula that we had up here. Annual coupon divided by price is the current yield, and that represents the rate of return if you hold a bond for a short period. Okay, exactly what I showed you here. If you hold a bond for a short period, your plan is this, but this is a little bit complicated. That's where the formula came from. Okay, I hope you're okay. Yeah. So do example 4. Let's finish this thing. Actually, let's stop there. I'll continue recording later.